So you're ready to buy a place, you saw that low advertised interest rate online or maybe in a local paper, and you decided, hey, I'm ready to go into my bank and get qualified for a mortgage. You get to the bank, find out, wait a minute, I don't actually qualify for the interest rate that was advertised. But why would this be? Well, there's fine print for a reason, right? The low advertised interest rate is based on a specific scenario. It's typically based on having perfect credit, a large down payment, 20% or more. You're buying a primary residence, single family residence. Those are all the perfect scenario to get the best interest rate, but not everyone fits into that mold, right? Maybe you're looking to buy a condo, or maybe you don't have perfect credit. You only have 5% to put down, which is common. Well, you're not going to get that low advertised interest rate. You can still get a low interest rate, but it's not necessarily going to be what you expected. So the main reasons why the rate could vary from what's advertised is, like I said, for one, credit score. That's the most common. They're going to advertise rates that are based on having perfect credit. They're never going to advertise the subpar credit interest rate because it's not going to be attractive. So they show you this low interest rate that's based on someone having 780 plus credit, not 680 credit, which is a more common credit score for borrowers. And if you have that lower credit score, well, it's going to result in a higher interest rate. Doesn't mean it's going to be an astronomical interest rate. It just means it's not necessarily going to be the rate you see advertised, because if you have lower credit, it typically results in higher risk, therefore results in a higher interest rate. You have a lower credit score for a reason. Maybe you haven't made your payment to your bills on time, or you have maxed out credit card debt. These are things that can affect your score and in turn affect your interest rate. On top of that, the down payment. The lower the down payment, the higher the risk it is for the bank and the higher interest rate that results from that. If you're buying a vacation home or you're buying an investment property, it's not going to be a home you're going to live in. Once again, higher risk for the bank, which results in a higher interest rate. You also need to see what type of mortgage you're looking for. A lot of times they'll advertise the rates for an adjustable rate mortgage, where the rate actually doesn't stay fixed for the entire term. So if you're looking for a 30-year fixed rate mortgage, but they're advertising a 5-year adjustable rate mortgage, means that the rate is only fixed for the first 5 years. Well, that results in a lower interest rate because the bank's not having to guarantee this rate for a full 30-year period. Maybe you're looking for a shorter term. You're looking for a 15-year. Well, the rate's going to be different than what you'd see advertised on a 30-year. So all of these things are factors in determining what your interest rate would be and why the advertised interest rate might not necessarily be what you receive. On top of that, you have the opportunity to buy a lower than market interest rate using discount points. So discount points are prepaid interest that's paid at the time of closing to buy a lower than market rate. One discount point is equivalent to 1% of whatever you're borrowing. So if you borrowed $300,000, you paid one discount point, that'll be $3,000, and it's paid as part of your closing costs and would result in a lower interest rate and therefore a lower monthly payment. When you go to the bank or the lender to speak with them and determine what options are best for you, I think one of the most important things to note is how long do you foresee yourself keeping the property, or how long do you think it's going to take you to pay off the mortgage? It might not necessarily make sense to take a 30-year fixed rate mortgage, which would typically have a little bit higher interest rate, if your plan is to only keep the home 5 years, right? Maybe an adjustable rate mortgage would make more sense because it gives you a lower interest rate and therefore a lower monthly payment for the time that you actually have the home. So keep all these things in mind. The biggest note to take away from this is that the advertised interest rate won't necessarily be the rate you qualify for. Every bank does not have a specific interest rate of the day that is available. Every individual qualifies for a different interest rate based on their exact scenario. So keep that in mind. Get with your bank or your local lender, discuss your options, discuss your home buying goals, and determine what interest rate would be best for you and what interest rate you qualify for.